All right, let's jump right into this explainer. Today, we are unpacking a fascinating report that paints a picture of an industry at an absolute crossroads. We're looking at the state of global banking as we head into 2026. Now, on the surface, things have literally never looked better for the financial sector. But just beneath that glossy veneer, a massive storm is brewing. We're going to explore a huge paradox that's just hiding in plain sight, and then we're going to identify the predators that are finally, after years of hype, starting to actually eat traditional banks alive. Okay, let's dive into it. $1.3 trillion. Let that sink in for a second. In 2025, the global banking industry didn't just have a good year, it had a record-shattering year. Net income hit an unprecedented $1.3 trillion, which is actually up 7% from 2024's already record-setting tally. Once again, banking generated the most net income of literally any industry on the entire planet. Balances grew, investors got higher dividends, and banks socked away almost $1 trillion in surplus free cash flow. If you just glanced at the income statement, you would absolutely think this was an unstoppable golden age.
But hold on, because here's where we hit the brakes. We've got a glaring paradox on our hands. Despite those mountain-sized profits, banking suffers from the lowest price-to-book and price-to-equity ratios out there. In simple terms, investors think traditional banks are practically valued at less than the sum of their parts. It's been lagging for years, and even this recent streak of success hasn't really closed that gap. Plus, the return on tangible equity actually started dropping again, down to 11.8% in 2025. The real story here isn't the profit, it's a massive lack of market confidence.
So you really have to ask yourself, why on earth are investors rejecting the long-term vision of the most profitable industry on earth? I mean, if you're making $1.3 trillion, why isn't the market rewarding you with sky-high valuations like we see in the tech sector? Well, the answer is that the smart money sees the hidden vulnerabilities. They remember the lost decade following the global financial crisis, and they see that the very foundation of the industry is fracturing, both geographically and technologically. Let's look at that geographical fracture first. That geographic fracture is completely reshaping the industry. For decades, the banking world essentially marched toward a unified, standardized global model, but that era is effectively over. If we map out banks by their efficiency and business models today, the data reveals a split into 6 distinctly different regional models. Banks in some parts of the world are now doing business in a completely different way from their peers elsewhere. It's almost like they're playing different games entirely. To really get a feel for these new regional realities, let's compare North America with the Gulf Cooperation Council, or GCC. In North America, the system is highly disintermediated, sitting at 64%. That basically means North American banks rely heavily on advanced capital markets, generating fees from wealth management and credit cards rather than keeping loans on their own balance sheets. But look over at the GCC. Their disintermediation is just 16%. They rely heavily on traditional balance sheet corporate lending, but they counter that with incredibly strong cost efficiency. We're talking a cost-to-asset ratio of just 0.9%. There is simply no single global playbook anymore. And because that single playbook is gone, the traditional giants are pulling back. Think about the massive shift over the last 20 years. Back in 2005, half of the top 20 biggest banks in the world were global universal banks. You know, those massive institutions trying to be everywhere for everyone. By 2025, that number plummeted to just 4. What replaced them? Dominant continental players. Banks are shutting their far-flung global retail outposts and doubling down on platforms that dominate specific, contiguous regions. Okay, so the global model is dead, but honestly, that's just an internal shift. The real danger, the actual reason investor confidence is so shaky, is external. In 2025, 4 disruptive forces finally hit a critical tipping point. These are the predators. We are talking about mature fintechs, highly aggressive neobanks, the rapid acceleration of AI and stablecoins, and a fundamental shift in customer trust. Together, these forces are directly threatening a bank's most vital asset, customer primacy. The core banking relationship itself is literally under siege. For about 20 years, traditional banks basically treated fintechs as minor irritants. But 17%. That is the share the top 1,000 fintechs have now captured of comparable industry revenues. That's $625 billion flowing away from legacy institutions. And here is the real kicker. Those exact same fintechs now make up a staggering 37% of the market value when compared to the top 1,000 banks. Investors are voting with their wallets. betting for sure that these lean, tech-first attackers are the actual future of finance. And then you've got a specific breed of fintech that presents a much, much more acute threat. The source report actually uses a brilliant horror movie analogy for this. The call is coming from inside the house. We're talking about neobanks. These aren't just your standard payment apps. These are fully licensed, digital-only banks offering all the traditional banking services, but completely without the massive overhead of physical branches. And they are actively, aggressively cannibalizing the market share of legacy incumbents. This completely shatters traditional banking rules. Just consider the trajectories for neobanks like Revolut and Nubank. Revolut now has 69 million customers, and Nubank has an astonishing 131 million. Historically, in banking, you either had high growth or high profitability. You rarely got both. But these neobanks, they're boasting return on equity numbers well over 30%, meaning they're generating massive profit off their capital, all while growing at speeds traditional bankers thought were mathematically impossible. Well, actually, maybe not impossible, but definitely unprecedented. So why are customers actually flocking to them? Well, the underlying data reveals something absolutely terrifying for traditional bankers. Fintechs are crushing legacy banks in customer satisfaction. We're talking a massive 24 percentage point advantage. But the real death blow here is trust. Since like the 16th century, trust has been the ultimate defensive moat for traditional banks. Even if they were clunky or slow, you trusted them with your money. Not anymore. Fintechs have actually usurped traditional banks, scoring higher on the ultimate metric of consumer trust. Now, you might be wondering, how did traditional banks survive this long if their tech was lagging so far behind? Well, they enjoyed what we call a grace period. In other industries, like music or retail, when digital hit, the business model had to flip pretty much overnight. But banking had a massive cushion. Older, highly profitable customers who were bound by sheer inertia. They didn't want to switch, so banks didn't really have to innovate all that quickly. They just layered expensive digital apps right on top of their old expensive branch networks. But that grace period, it is violently over. Generative AI is just obliterating the slow adoption curve we used to see. Generative AI adoption is moving 7 times faster than the rollout of digital banking ever did. It took digital banking 15 years to reach critical mass. AI reached 45% of the working population in just 2 years. And this tech isn't just for young techies either. Older demographics are piling in at nearly the exact same rate. So the really crucial point here is how this technology changes human behavior. Traditionally, banks made huge profits off our inertia, leaving extra cash in a checking account earning 0 interest. But enter agentic AI. These are AI agents that act entirely on your behalf. They automatically monitor your accounts and instantly sweep your idle cash into high-yield accounts, effectively destroying the bank's profit spreads. And when it comes to moving money, stablecoins, which are projected to hit $4 trillion in adoption by 2030, are offering near-instant, dirt-cheap cross-border settlements, threatening massive chunks of traditional payment volumes. For decades, the winning strategy in banking was basically to be the tortoise. Practice smart followership. Let the other guys take the technological risks, and then slowly adapt once things were totally safe. That strategy is officially dead. The sheer velocity of AI, the massive scale of neobanks, and the rapid shifting of consumer loyalty mean that taking it slow is literally a death sentence. Banks must urgently transition into high-speed hares if they want to survive this decade. Which brings us to the absolute new mandate for the industry: precision with speed. It is just no longer enough to have a decent digital app. Banks need to deploy dynamic, hyper-personalized strategies in real time. They have to run continuous micro-campaigns and instantly adapt to whatever their AI models are telling them. They need the strict risk discipline of a traditional bank, but the unrelenting execution velocity of a tech startup. Because the numbers are crystal clear. A cool $1.3 trillion in profit today is absolutely not going to protect you from the technology of tomorrow. Neobanks are at the gates, AI is inside the vault, and the grace period is officially over. So we'll leave you with this to think about. Whether you work in finance, invest in it, or just keep your money in a standard checking account, will your bank become a high-speed hare, or will it be left completely behind in the AI revolution? Thanks for joining us for this explainer, and keep questioning what's next.